While large corporations dominate the news, small firms are the primary drivers of net job creation. This video explores 8 fundamental reasons why entrepreneurial ventures generate disproportionate employment opportunities compared to larger counterparts. This video is brought to you by the Series of Thoughts team as part of their economic studies program. We begin with the job creation paradox. Small firms create more net new jobs than large corporations, a reality stemming from differences in business structure and growth dynamics. Firms with fewer than 500 employees create 64% of net new jobs annually. Chapter 1 discusses the fast growth phase of the business lifecycle. Small firms experience rapid expansion in their early years from a minimal employee base. This creates dramatic percentage increases in headcount, translating to substantial net job creation across the economy. The mathematics of percentage growth illustrates this effect. A 20-person small firm adding 5 employees achieves 25% growth. In contrast, a 20,000-person large firm adding 5 employees grows by a statistically negligible 0.025%. Early-stage companies engage in aggressive hiring to capture market demand quickly. This urgency drives founders to hire ahead of revenue to build capacity for anticipated growth. Unlike established firms, small businesses must construct entirely new teams and capabilities from scratch. Growth rates are structurally higher due to 3 factors. The low base effect means every hire represents meaningful percentage growth. Market entry demands require rapid team building, and investor expectations often demand hypergrowth trajectories. Chapter 2 highlights fewer bureaucratic constraints. Organizational complexity slows large firms with layers of approval and compliance. Small firms bypass these, enabling rapid decision-making and immediate action on hiring needs, often in days, not quarters. There is a significant speed advantage in hiring decisions. A small firm often hires within 1 to 2 weeks, while a mid-sized firm takes 4 to 8 weeks. Large corporations can take 3 to 6 months due to planning cycles and executive approvals. Small firms pivot faster when opportunities appear, hiring within days and creating custom roles tailored to immediate needs. Large organizations often remain locked into rigid headcount allocations, limiting their ability to respond to market shifts. Small firms have no legacy processes, slowing expansion. Established companies inherit decades of accumulated procedures, creating friction. Small firms build processes from scratch, optimizing for current market conditions and enabling unencumbered employment growth. Chapter 3 covers operating in emerging or niche markets. Small firms identify new customer needs and unmet demand before established players. This often leads to category creation, inventing entirely new markets that require new jobs. Innovation drives new market creation. When entrepreneurs identify market gaps, they build teams to serve them, generating net new employment. This cycle involves identifying the gap, building the team, launching the product, and scaling operations. Small firms absorb demand that incumbents ignore. Large corporations pursue opportunities meeting high revenue thresholds, leaving niche segments unserved. Small firms fill these gaps profitably, creating localized employment that aggregates into substantial job creation. Chapter 4 explores taking more calculated risks. Small firms are willing to hire ahead of revenue, betting on growth trajectories. Founder risk tolerance and the creation of experimental roles also accelerate job generation. The optimization versus growth mindset highlights the difference. Large firms focus on optimizing existing headcount and protecting margins. Small firms gamble by investing ahead of demand, accepting lower short-term profitability for market share and capacity building. Job creation is a byproduct of growth, not a deliberate goal for small firms. They hire to capture opportunities arising from entrepreneurial ambition and market expansion. Supporting entrepreneurship yields more sustainable employment growth than direct job creation programs. Chapter 5 discusses how higher job turnover creates net jobs. Small firms experience an average annual turnover of 34% compared to 18% at large corporations. Despite this, small firms maintain an 8.7% annual net job creation rate. High turnover drives creative destruction in microform. Continuous rehiring inflates gross job creation, but also creates opportunities for workers to enter the labor market, gain experience, and move into better positions, benefiting the broader economy. Here is an example of high turnover still producing net growth. A small firm of 50 employees might see 17 departures, but by hiring 20 people for replacements and additional capacity, they end the year with 53 employees, creating 3 net new jobs. Chapter 6 focuses on small firms as the primary vehicle for entrepreneurship. Every new business starts small, creating immediate employment opportunities and providing economic resilience during downturns. The youngest firms create jobs at dramatically higher rates than mature businesses. Business formation is the most reliable driver of employment growth across industries, geographies, and economic cycles. Startups create jobs when established firms shed them. During the 2008-2009 recession, large firms shed 8 million jobs, while new businesses created 3 million positions, highlighting this counter-cyclical pattern. Entrepreneurial ecosystems amplify job creation. Successful startups spawn additional ventures as experienced employees leave to found their own companies. This compound growth generates employment at higher rates over time. Every new business is a job creation experiment. The process involves testing a business model, hiring an initial team, launching to market, measuring results, pivoting or scaling, and ultimately generating sustainable jobs. Successful ventures create disproportionate jobs. Chapter 7 covers how large firms often shed jobs during efficiency drives. Public companies face pressure to improve productivity and reduce labor costs through automation, outsourcing, and restructuring, which creates downward pressure on job creation. Corporate job reduction is driven by 3 pillars: automation and technology, outsourcing and offshoring, and restructuring and consolidation. Each initiative replaces human labor or eliminates redundant positions to improve efficiency. Shareholder pressure drives cost-cutting over expansion. Investors reward companies for growing revenue faster than expenses, creating a systematic bias against job creation in mature firms. Cost reduction is a higher investor priority than growth. Chapter 8 shows that small firms are closer to customers. Proximity enables small firms to detect demand shifts immediately and respond with rapid hiring. Decisions reflect observed behavior rather than slow market research cycles. Small firms respond to demand spikes faster. They can identify a spike in week 1, make a hiring decision in week 2, begin recruiting in week 3, make offers in week 4, and have new hires start by week 6. In summary, 8 factors drive small firm job creation: the fast growth phase, fewer constraints, new markets, risk tolerance, healthy turnover, entrepreneurship, the dynamics of large firms, and customer proximity. Supporting entrepreneurship is key for employment growth.